The silver market is running a structural deficit, has been for 3 years straight, and the mainstream financial press has said almost nothing about it. Here is what that means. Every single year for the past 3 years, the world has consumed more silver than it has produced. Not by a small margin, not within rounding error, by hundreds of millions of ounces. The gap between what comes out of the ground and what gets consumed by industry, by investors, by governments, has been widening consistently, and the price has not reflected it. Not yet. That disconnect between a worsening physical reality and a price that has not moved to reflect it is either the biggest mispricing in the commodity markets right now, or there is something suppressing the price that will eventually break. Either way, the outcome for silver is the same. In the next 18 minutes, I am going to show you exactly how large the silver deficit actually is, why the mainstream is not covering it, what has been masking it, and what happens historically when a structural commodity deficit finally breaks through into visible market pricing. Welcome to Economic Shadows. This is where we track the stories the mainstream misses, connect the geopolitical dots, and show you what is happening in critical markets before the crowd figures it out. If you are new here, subscribe now and hit the notification bell, because what I'm about to show you is not a trading tip. It is a structural market reality that is building toward an inevitable repricing event. Let us start with the numbers, because the deficit is not theoretical, it is documented. The Silver Institute, which aggregates supply and demand data from mining companies, industrial users, and investment flows, has reported a structural silver deficit for 3 consecutive years. In the most recent full reporting year, total global silver demand reached approximately 1.2 billion ounces. Total global silver supply, including mine production and recycling, came in at approximately 1.0 billion ounces. That is a deficit of roughly 200 million ounces in a single year. To put that in context, 200 million ounces is more than the entire annual silver output of Peru, the world's second largest silver-producing nation. It is a gap so large that it cannot be filled by drawing down recycling or adjusting mine output in the short term. It represents a genuine physical shortfall that the market has to absorb from existing above-ground inventories. And here is the critical point. Those above-ground inventories have been absorbing these deficits for 3 consecutive years. They are not infinite. They are not being replenished. They are being drawn down at an accelerating rate. And at some point, the buffer runs out. Now, why is nobody talking about this? Why is a 200 million ounce annual deficit not front-page financial news? 3 reasons. First, the data exists, but it is not assembled in a way that creates urgency in mainstream financial media. The Silver Institute publishes its World Silver Survey annually. The data is there. But annual commodity supply-demand surveys do not generate the same attention as earnings reports or central bank announcements. The financial press covers what moves markets today. A structural deficit that has been building quietly for 3 years does not have a single news hook that demands coverage. Second, the deficit has been masked by above-ground inventory drawdowns that make the physical shortage invisible at the surface level. When supply falls short of demand, the gap gets filled from existing stockpiles. Metal moves from vaults to industrial users. Prices do not spike because the physical metal is still available, just from a different source. The market does not feel the shortage until the stockpile buffer gets thin enough that sourcing physical metal becomes genuinely difficult. We are not there yet, but we are getting closer every quarter. Third, the paper silver market, futures contracts, ETFs, derivatives, is large enough relative to the physical market that it can absorb and suppress price signals that would otherwise reflect physical scarcity. When industrial buyers need silver, they often hedge through paper instruments rather than sourcing physical immediately. This paper layer insulates the spot price from the underlying physical reality, but it does not eliminate the physical reality. It delays the price signal, and when the delay ends, the catch-up move tends to be violent. Now let me break down exactly where the demand is coming from, because understanding the demand side is what makes this deficit structurally different from anything the silver market has seen before. The silver deficit is not being driven by investment demand alone. It is not a speculative bubble waiting to deflate. It is being driven by industrial consumption that is structural, growing, and largely price inelastic. Solar energy is the dominant driver. A single solar panel requires a small but meaningful amount of silver in its photovoltaic cells. Multiply that by the scale of global solar deployment, and the numbers become staggering. Global solar installations have been growing at double-digit rates annually for the past decade. In the most recent reporting year, the solar industry consumed approximately 200 million ounces of silver. That single end use alone is equivalent to the entire annual silver deficit. And solar deployment is accelerating, not slowing. Government mandates, falling installation costs, and corporate renewable energy commitments are driving solar growth regardless of silver prices because silver is a small input cost relative to the total system cost. Solar manufacturers are not going to stop building panels because silver costs more. They will absorb the cost increase and pass it on. Electric vehicles are the second major driver. Every EV contains silver in its electrical systems, battery management circuitry, and charging infrastructure. As EV penetration accelerates globally, silver demand from the automotive sector is growing at a rate that most market models have consistently underestimated. The forecasts that were published 5 years ago for EV-related silver demand have already been exceeded. The revised forecasts being published now will likely be exceeded again. The third driver is the broader electrification of everything: 5G infrastructure, data centers, medical devices, water purification systems, defense electronics. Every sector that is growing because of the technology transition requires silver somewhere in its supply chain. This is not one demand driver. It is a dozen demand drivers all accelerating simultaneously, all pulling from the same constrained supply base. And on the supply side, the story is equally stark. Global silver mine production has been essentially flat for nearly a decade. The reasons are structural. The major silver-producing mines are aging. Ore grades at existing operations are declining, meaning miners have to process more rock to extract the same amount of silver. The capital investment required to bring new mines into production has a 7 to 10 year lead time from discovery to first production. The investment decisions that would have been needed to significantly grow supply today would have had to be made a decade ago. They were not made at sufficient scale. Primary silver mines, operations where silver is the main product, account for only about 30% of global silver production. The remaining 70% comes as a byproduct of copper, zinc, lead, and gold mining. This means silver supply is largely hostage to the economics of other metals. When copper miners slow production because copper prices fall, silver production falls too, regardless of what silver prices are doing. Silver supply cannot respond to silver price signals the way a primary commodity can. Recycling provides some flexibility, but not enough to close a 200 million ounce annual gap. Total silver recycling runs at approximately 180 million ounces per year globally. It has been growing, but at a pace that trails the growth in industrial demand. The result is a supply side that is structurally constrained, slow to respond, and increasingly insufficient to meet a demand side that is growing rapidly and showing no signs of deceleration. Now let me show you what history tells us about how this plays out. Because the silver deficit is not a unique situation. Structural commodity deficits have occurred before in other markets, and the price outcomes when the deficit becomes impossible to ignore follow a recognizable pattern. The uranium market in the early 2000s provides the clearest parallel. For years through the 1990s, uranium supply came primarily from the dismantling of Soviet-era weapons stockpiles. This overhang of above-ground inventory masked a structural production deficit. Mine supply was insufficient to meet reactor demand. But because the stockpile buffer existed, prices stayed low and investment in new mine development stalled. Then, in the early 2000s, the weapons stockpile supply began to run out. The buffer disappeared. The underlying production deficit became visible. Uranium prices went from under $10 per pound in 2003 to over $130 per pound in 2007. A 13 times price increase in 4 years, driven entirely by the market finally having to price a structural deficit that had been masked for a decade. The silver parallel is direct. Above-ground silver inventories have been playing the same role that Soviet weapons stockpiles played in the uranium market. They are the buffer that masks the underlying production deficit. And like the uranium stockpiles, they are finite. They are being drawn down. And when they are insufficient to continue filling the gap, the price will have to do what prices do when supply cannot meet demand. It will rise to the level that destroys enough demand or incentivizes enough new supply to rebalance the market. At current demand growth rates, the price increase required to rebalance the silver market is not modest. The copper market in the early 2000s provides a second parallel. Copper ran a series of annual supply deficits through the late 1990s and early 2000s. The deficits were documented but largely ignored by a mainstream financial press focused on technology stocks and then on the aftermath of the dot-com crash. Copper prices languished under $1 per pound for years. Then the demand from China's industrial build-out collided with the supply deficit, and prices went from under $1 to over $4 per pound over the following decade. The deficit was not the only driver, but it was the foundation that made the price move structural rather than cyclical. The lesson from both markets is the same. Structural deficits do not produce immediate price responses. They produce delayed responses that are larger than anyone expected, because the delay allows the imbalance to compound. The longer the deficit persists before the market prices it, the more violent the eventual repricing. Now let me walk you through the sequence of how I think the silver deficit story plays out from here. Phase 1 is the continuing accumulation of deficit. This is where we are now. The deficit persists. Inventories continue to be drawn down. The price remains relatively suppressed by paper market mechanisms. Most investors remain unaware of the underlying physical reality. Phase 2 is inventory thinning becoming visible. This is when the drawdown of above-ground stocks starts to show up in measurable ways. COMEX registered silver inventories declining. London Bullion Market Association vault holdings contracting. Physical premiums over spot prices starting to widen as sourcing real metal becomes incrementally harder. We are beginning to see early signs of this phase right now. Phase 3 is industrial user scramble. This is when procurement teams at solar manufacturers, electronics companies, and EV producers start to notice that their silver supply chains are tightening. Lead times stretch, spot premiums rise. Long-term supply contracts become harder to secure at previous prices. Industrial users begin competing with each other for available physical supply. Phase 4 is investment demand acceleration. This is when the supply constraint story reaches enough investors that investment demand adds to the pressure industrial demand is already creating. Silver ETF inflows accelerate. Physical coin and bar demand spikes. The paper market starts to feel the pressure from the physical market in a way it cannot fully absorb. Phase 5 is repricing. This is when the combination of structural deficit, depleted inventories, industrial scramble, and investment demand surge forces a permanent upward repricing of silver. Not a cyclical rally that gives back its gains, a structural shift to a new price level that reflects the genuine supply-demand reality. I cannot tell you exactly when each phase transition happens. Market timing is the hardest problem in investing. What I can tell you is that phases 1 and 2 are already documented. The evidence for phase 3 is beginning to accumulate, and the investors who wait for phase 4 confirmation before acting will have already missed the most significant portion of the move. So let me tell you how I am thinking about positioning based on this. And as always, this is my analytical framework, not financial advice. First, I am treating the structural deficit as the foundation of the entire silver thesis. Everything else, the geopolitical accumulation, the green energy demand, the paper market dynamics, those are accelerants. The deficit is the fuel, and the fuel has been accumulating for 3 years. Second, I am watching inventory levels as my primary leading indicator. COMEX registered silver stocks and LBMA vault holdings are publicly reported. When those numbers start declining in a sustained and accelerating way, it is the market telling you that phase 2 is transitioning to phase 3. That is the signal I am tracking most closely right now. Third, I am watching physical premiums over spot price. When the cost of acquiring a real silver bar or coin starts meaningfully exceeding the paper spot price, it tells you the physical market is tighter than the financial market is acknowledging. Rising premiums are how the physical market communicates what the paper market is suppressing. Fourth, I am patient and I am sized for a multi-year thesis. The uranium market took years from deficit recognition to full repricing. The copper market took a decade. Silver could move faster because the financial market infrastructure around silver is larger and more reactive. But I am not trading this. I am positioning for it. And fifth, I am continuing to educate myself and this community. The investors who understand the mechanism of a structural deficit, who understand the inventory dynamics, who understand the supply-side constraints, those are the investors who will hold their positions through the volatility and capture the full repricing when it arrives. The silver deficit is not a rumor. It is not a fringe theory. It is documented data from the industry's own tracking organizations. The question is not whether the deficit is real. The question is when the market stops ignoring it. Drop your thoughts in the comments. Are you tracking the inventory data? Are you seeing physical premiums widening in your market? This community's collective intelligence on what is happening at the physical level is one of the most valuable signals I follow. If this video showed you a layer of the silver market that the mainstream is not covering, if it gave you a framework for understanding why the deficit has not moved prices yet, and what happens when it finally does, hit that like button. Share this with someone who is watching silver but does not understand the structural supply-demand picture beneath the spot price chart. And subscribe to Economic Shadows because this is where we track the stories that matter before they become obvious. We do not react to headlines. We build the analytical framework before the headline exists. When the silver deficit becomes front-page news, when the inventory drawdown becomes impossible to ignore, when the repricing event arrives, you will already understand exactly what is happening and exactly why. And more importantly, you will already be positioned for it. I will see you in the next one. Stay sharp. Follow the data.